Good evening, everyone, and I welcome you all to another class on corporate reporting. This is my third class, and today we are going to be looking at a new topic called IFRS 2 on, on share-based payments. Share-based payments. In week 1, we looked at regulatory framework, and what we learned in regulatory framework was that reporting is governed by regulations, and these regulations are developed by regulatory bodies. So we looked at the regulation, which are GAP. Then we looked at the regulatory bodies. In week 2, which is last week, Monday, we proceeded to conceptual framework. And conceptual framework majorly are the principles that are used to develop IFRS. Remember that we have agreed and I've explained to you in week 1 that IFRS is principle-based. So in developing IFRS, they are developed from set of principles, which is the conceptual framework. We looked at the advantages and disadvantages of this conceptual framework, as well as the purpose of this conceptual framework. We then proceeded to looking at the content, which are the set of principles. We started out with chapter 1 that talks about the objective of a general purpose financial report. In that chapter 1, we learned about what a financial information is and the fact that these financial information are prepared on an accrual basis. And also we learned about the primary users of financial statement. Then in chapter 2, we learned about the qualitative characteristics of a useful financial report. We learned about the characteristics that makes the report useful or not useful, which are the fundamental characteristics. And these fundamental characteristics are also two. We say there is a faithful representation and there is relevance. Those two are powerful. Everything in reporting is built around those two. All IFRS is built around those two, relevance and faithful representation. And I told you about relevance, that a report is relevant when it is capable of making a difference in the decision that is made by users, and is capable of making a difference if it has predictive value and confirmatory value. Predictive value, I told you, it means you can use it to make predictions. And confirmatory value, it means it should be able to confirm your past predictions. And I also explained how a report can have predictive value from the fact that it has diluted EPS in the report, from the fact that also there is comparative information, and also non-current asset held for sale, and also discontinued operations. All of these give the report predictive value. Faithful representation looks at that the information must be complete, neutral, and free from error. And we also looked at the principle of substance over form. We went on to chapter 3. Chapter 3 looks at financial statements on the reporting entity. So that basically talks about what a reporting entity is, saying that a reporting entity does not necessarily have to be a legal entity. It can be a single entity, a part of a single entity, or group of entities. Then chapter 4 talks about elements of financial statements, where we defined each of these elements. Then chapter 5 looks at recognition and derecognition. We looked at the definition, we looked at the recognition criteria and the derecognition criteria. Chapter 6 talks about measurement, where we looked at the two measurement bases that we have, from historical cost basis to current value basis. We explained those critically. Chapter 7 talks about presentation and disclosure. That was where we learned that income and expenses are recognized in profit or loss, but income that are arising from changes in the value of assets or liabilities should be recognized in the other comprehensive income. While chapter 8 talks about the concept of capital and capital maintenance, we learned about the two concepts of capital, which is the financial concept of capital and also the physical concept of capital. And we also learned around that these capital are maintained when you make profit. And we could either have financial capital maintenance or physical capital maintenance. We explained all of this in our last class. This material I'm presenting to you, you have it. All I've explained is there. The last class, which is the video that we had, I've shared it with you. So you have all the materials to revise. As of now, it is assumed that you should have revised chapter 1 and chapter 2. Week 1 and week 2 class. It's assumed you should have revised it. Today, we are going to start a journey of accounting standards. So almost for the next almost 10 weeks, back to back, we would be learning accounting standards. And the very first of which I'll be teaching you is IFRS 2. This will take me 2 classes to finish. We have to finish it in 2 classes. It's wide, interesting, simple, and straightforward. So today, we have IFRS 2 in front of us. And these are what we're going to cover and more. I didn't even write everything. There are more. I didn't put deferred tax. There's deferred tax. Deferred tax implication. Okay, so what is this standard IFRS 2 share-based payments? What is it talking about? So what we are looking at is this. You see, normally, the way transactions are consummated is such that a seller or a supplier will transfer goods to a buyer. And either the buyer pays immediately or the buyer chooses to pay later. So if the buyer decides that, okay, I want to pay immediately, the way we record it in our books is we simply debit purchases. If he's buying goods, or if he's buying another asset, we debit assets and we simply credit bank. That is the normal way of recording transactions. Or if the buyer wants to pay later, where he is buying those goods on credit. So we simply debit purchases or assets and we credit trade payables. And you can think of any type of transaction that we normally consummate It's either you're buying assets, or you're incurring expenses, or what have you. That is the way transactions are consummated normally. Where share-based payment is coming in is that the buyer, which is the focus of everything I'll be teaching you, we are focusing on the buyer. So where share-based payment is coming in is that unlike the conventional transaction I mentioned above, now the buyer wants to settle, instead of paying money or buying the goods on credit, he doesn't want to pay money or buy the good on credit. He wants to pay with his own shares or share option. He wants to pay with his own shares or share option. So he's saying that I don't want to pay with my money now. Neither do I want to pay later. What I want to do is I want to pay with my shares, with my equity instrument. And that is what this old standard is all about, IFRS 2 on share-based payment. That unlike the conventional way with which we consummate transactions, we are saying that instead of paying money outrightly or later, we want to pay for goods with our shares or share option. We want to pay for it with our equity instrument. Let me put it like that. So in that scenario, it means we will debit purchases and we'll credit shares or share option. You see, these transactions generally that I've mentioned, where entities receive goods or services and they want to pay with their shares. And paying with their shares, they usually consummate this transaction mostly with their employees. They mostly consummate this transaction mostly with their employees. But we are going to look at the various dynamics of it. Now, if this thing is this straightforward, okay, somebody said they can't hear me clearly. So what I've said so far is that everything we want to study today is a situation whereby entities buy goods and instead of paying with money normally, they decide to pay with their equity instruments. And I was saying that this type of transaction is common with employees. They usually put it as part of employee remuneration or director's compensation, that, okay, if you work with us for some years, we are going to give you some shares, maybe much later into the future. So it's common in that regard. That's majorly what we want to look at today. So if it is that simple, if it's just about entities receiving services and then paying for those services with their, so why do we have a standard for it? Why must we then be studying it for, like I said, it's going to take us almost 2 classes. Okay, so you are going to see that there are a lot of dynamics to entities giving their shares as a form of payment. And there is always these valuation issues, and there are a lot of uncertainties around it. And those complexities that can arise are majorly why we are studying it as a separate standard. And the fact that this form of payment has been existing for a while, and organizations have been treating it wrongly. They have been treating it wrongly, and also is the reason why we have a standard to ensure that companies treat it the right way. Now, so the first thing, there are certain terminologies that we need to get used to. And the very first of it is a share-based payment transaction. And a share-based payment transaction is a transaction in which an entity receives goods or services as consideration for equity instrument of the entity. So let me stop there. A share-based payment transaction is a transaction in which the entity receives goods or services as consideration for equity. So this is not far from what I've explained to you before. An entity receives goods or services, then it uses its equity to pay for those goods or services. Additionally, it says, or acquires goods or services by incurring liabilities to the suppliers of those goods or services for amounts that are based on the price of the entity's shares or other equity instrument of the entity. So another way that we have share-based payment transaction is that an entity may buy or receive goods or services by incurring liabilities to the supplier of the goods or services. So by incurring liabilities simply means that they agree to pay cash. They agree to pay cash later, not now, that, okay, we will pay cash. So that's what is making them have liabilities, that, okay, we will pay cash. But the amount of cash, the amount of money they will pay will be based on the price of the entity's shares. So they are paying cash, but the amount of cash they will pay is based on the price of the entity's shares. So when we have a share-based payment transactions, from this definition, we are looking at it from two ends. Number one is the entity receives goods or services, then the entity would pay with their equity instruments, with their shares or share options, with their equity instruments, or they receive goods or services and they will pay cash, okay, later. That's why they say by incurring liabilities, they will pay cash later, so they are owing. But the amount they will pay, the amount of cash they will pay is based on the price of the entity's shares. So everything is still around the entity's shares. So one is they are giving their shares or share option as consideration. Number two is that, okay, we will pay cash, but the amount we will pay, we are tying it to our shares, our share price, okay? So that's a share-based payment transaction. Now, before a share-based payment transaction can be consummated, there has to be an arrangement or an agreement. So the agreement that backs up that an entity must enter into, okay, before they can enter into a share-based payment transaction, that's a share-based payment arrangement or a share-based payment agreement. Another terminology that I've been mentioning is equity instruments. Equity instruments. And this is one in which I said that this is one of the form of payments that they have chosen to use to pay for those goods or services, equity instruments. And from our knowledge of conceptual framework, we already know that equity instrument is a residual interest in the assets after deducting all liability. So, but put it simply, equity instrument is just shares and share options. Shares and share options, okay? Is it that we are giving ordinary shares or we are giving our share option? So, if it's shares that we are giving, ordinary shares, that means the counterparty or the seller or the supplier, the person that is giving us goods, okay, that person becomes a shareholder immediately if what we are giving as considerations for those goods is shares, that we receive goods from somebody or we receive service from someone, and those persons, we decide to give them our shares. Say, okay, we have issued you our shares. They become shareholders outrightly. Okay, but they can also give share option. They can also give share option. When they give share option, the holder of that share option, either the counterparty, who can either be the supplier or the employee or the seller, whoever is the holder of that option, what that person has is a right to receive shares or to subscribe to the entity's shares at a fixed determinable price for a specified period of time. So if the entity is giving share option for the goods or services they have received, what it simply means is that, okay, you cannot become shareholders now, but this option we are giving you is giving you a right to buy our shares, a right to receive our shares, a right to subscribe to our shares at a fixed price, at a fixed date, at a fixed price, at a fixed date. That is share options. However, this share option, you would see that since whoever that is going to get it, which can be the buyer or whoever the counterparty is, you will see that the person in fact, will be required to meet some options in most instances. They will say it needs to meet some options or it needs to meet some conditions before you can get those shares or before that option will crystallize or before you can receive those shares. It will meet some condition. So in this case, those conditions here, we call them vesting conditions, which are the conditions that the counterparty must satisfy before it can get or receive shares. So when what we are giving to a counterparty is a share option, which is mostly a contract, is a document that is stating that, okay, you can buy our shares at a fixed price, at a fixed future date, usually come with conditions. Those conditions, we call them vesting conditions. And this vesting condition is either it is a service condition, and which will require that if the counterparty is an employee, and in most instances, it is an employee that they give share options to. They don't give it to a supplier in most cases or a seller. They don't give it to those ones because those ones would have already met the whatever conditions. Those ones will have delivered the goods. It is employees that they give share options to because they want the employees to work for them for a long time before they can exercise those options, before they can receive those shares. So it comes with conditions. And those conditions, I said, they are called vesting conditions. One of those vesting conditions could be service condition. And this service condition is simply that, okay, you are supposed to work for us for some period of time, maybe 5 years, maybe 10 years, whatever it is that is the agreement. And it could also be performance condition, where they would attach those shares, they will attach it to maybe a profit target or a sales target. that before you can receive these shares, you need to meet certain target sales or target profit. Those are the vesting conditions. And these vesting conditions, they usually last for a period of time. And that period, we call it vesting period. Vesting period, which is the period required for the counterparty to meet those conditions or to satisfy those conditions. Now, eventually, they might satisfy the condition. And when they satisfy those conditions, then the employee will be entitled to those shares. You can then receive them. The terminology we use for that is vest. When an employee becomes an entitlement to those shares, when he has right over those shares, after he has met those conditions, then the share option will vest. That's the relevant terminology we do that. Another relevant term is grant dates. I told you that when entities enter into a share-based payment transaction, there are usually an agreement that backs it up. There's usually an agreement that backs it up. So the dates in which that agreement is signed, the date in which the entity and the counterparty enter into that agreement, we call that date a grant date. And if these share-based payment transactions require some approval, the date that approval is granted is called a grant date. It's called a grant date. And of course, when those shares are then granted, we call it equity instrument granted. Okay. So we're also going to be meeting some terminologies like fair value. You will see that in most cases, those shares that we are giving to the counterparty will be valued at fair value. So we will be mentioning a lot of fair valuation. And the date at which that fair value is determined, we call that measurement date. And finally, we are also going to meet intrinsic value. We are also going to say, I'll mention intrinsic value as I'm teaching you. And this intrinsic value is like the benefits of this whole transaction to the counterparty, whoever the person is, the benefit of it to that person. So, and it's usually the difference between the market value or the fair value or the share price of that company's shares, that if we were to go and buy the company's shares on the market, the price at which we will buy it, and the price in which we are expected to pay in this transaction, the price we're expected to pay. So the difference between the two is the intrinsic value. So for example, if the price we're expected to pay is 15 naira, and if we're supposed to go and buy these shares on the market is 20 naira, so that means we are gaining 5 naira. So this intrinsic value is like a profit, like the profit of this whole transaction to the counterparty. The profit the counterparty will get. I mean, that's what is making this thing attractive to anybody. There was like a documentary that I saw about Facebook. There was this guy that designed their office, like he's like a painter. He came to the office, do some painting and all of that. So the guy was supposed to get $40,000. The guy was supposed to get $40,000. So Mark asked him that, okay, we are a startup and we are trying to manage our cash flows. Instead of giving you this $40,000, can we give you shares? Can we give you some of our shares? The guy agreed that, okay, you can give me shares. So they gave the guy shares outrightly. So they cannot give him share option because he will have already offered the service. He has met the condition. He has painted their office. So they will give him outright share. So he became a shareholder immediately. So recently, I mean, the guy is now a millionaire in dollars, right? So that $40,000, that shares, he did not sell it. He just left it. And the guy is a millionaire. He doesn't have to work again because he entered into a transaction like this. That is the attractiveness of this type of transaction. The price that you're expected to pay compared to what the market price can be. But intrinsic value is looking at the price that you're expected to pay for those shares in the future compared with what's the market price today. The difference is the intrinsic value. So, and another thing I need you to really understand from all of these terms is that, yes, we have established the fact that companies pay with shares. When companies pay with shares, then it comes under the purview of IFRS 2 on how to account for that kind of transaction because it becomes a share-based payment transaction. But you need to understand that if those transactions are with employees, they will usually give employees share option because they will need those employees to meet some vesting conditions. But if they are entering those transactions with a supplier that will render its service outrightly, those ones will get shares outrightly. So you will see that the focus, what I'll be talking about mostly in this class, would be where companies issue share options to employees. Because if it is a situation of where they issue shares to a supplier, accounting for it is very straightforward. It's just to debit purchases and credit shares. And that is all. It's not more than that. But for share option, there are certain complexity because we're not giving shares right now. We're only giving we are only giving hope to the employee that, okay, you can buy our shares in the future at these dates if you meet these conditions. And that's what we're going to spend most of our time explaining to you today. So there are three types of share-based payment transactions. From what I've explained, I've already mentioned the three already, but we just want to pick it out again. There is the equity settled share-based payment transaction. There is the cash settled share-based payment transaction. And there is the equity or cash settled share-based payment transaction. So the first one, which is equity settled share-based payment transaction. This one is the one in which the entity receives goods and decides to pay with their equity instruments. They receive goods, and it's okay, we are going to pay with our shares or share options, as the case may be. Another one is cash settled share-based payment, where the entity receives goods, but they will pay cash, but not now. They will pay cash later. But the amount of cash they will pay is now based on the share price, on the price of the entity's shares. They attach the amount of cash they will pay on the entity's shares, on the entity's share price. So for this cash settled, I will be talking about something called, they call it share acquisition rights. Share acquisition rights. So share acquisition is like, okay, I would pay you if my shares increase by 10%. I will pay you that whatever my shares is at that date. So they are attaching it to appreciation of our shares. Okay, I will pay you this amount based on appreciation. So the counterparty is definitely sure that, okay, these shares I will only get cash based on appreciation, not devaluation, because it's possible that those shares could also reduce in value, right? Or another way in which they do this cash settle, we can give the counterparty redeemable shares, meaning shares that we are going to give you these shares now, but we have agreed the date at which we are going to buy it back from you. We're going to buy it back from you and give you cash, redeemable shares, right? Of course, they'll be buying it back at the point where it is favorable to the counterparty, because the supplier or the employee or whoever will not want to lose out. So those are cash settled share-based payments. Also, the third one, which is let me call that equity or cash settled. Okay. So this one is the one in which the entity receives goods or services, and either the entity or the counterparty, which is the supplier, has a choice as to whether the entity would settle that transaction with shares or with cash. Okay. Whether the entity settles with shares or with cash. So that's the third one. So that one is equity or cash, right? Okay, so that's the introduction of what we want to talk about today. Now, the very next thing now is for us to go to how do we account for these things? How do we account for these three types of share-based payment transactions? But before I go there, because I can't see you guys, I can't see anybody language. I don't know whether you're following. So let's just look at these quizzes together, and just to be sure that you're following me. So let's look at the first one. It says, which of the following is not a type of share-based payments transaction? A, transactions where an entity receives goods and either the entity or the supplier has a choice as to whether the entity settles in cash or equity. Transactions where an entity receives goods and settles the transactions with equity. Transactions where an entity receives goods and we settle in cash in 2 weeks. Transaction where an entity receives goods and settle in cash that are based on the share price of the entity. Which of the following is not a type of share-based payment?
C.
You said C.
Yes, sir.
Okay, that's correct. C is the correct answer. Number 2, transactions where an entity receives goods or services in exchange for the equity instrument of the entity is known as. What was the answer?
B.
Okay, that's correct. B, equity settled. Number 3, so transactions where an entity receives goods in exchange for cash that are based on the share price of the entity is known as.
B.
Okay, B, that's correct. Okay, the answer is B. Number 4, a contract that gives the holder the right, but not the obligation, to subscribe to the entity's shares at a fixed or determinable price for a specified period of time is known as
Share option. B.
is C, not B. So the answer is share options. C. Number 5. A transaction in which an entity receives goods or services as consideration for equity instrument of the entity or acquires goods or services by incurring liabilities to the supplier of those goods or services for amounts that are based on the price of the entity's shares or other equity instrument of the entity is known as what?
B.
No, it not be.
A.
The answer is C. Thank you, Christina. The answer is C. That's share-based payment. You will see that this one includes the entity receives goods in exchange for equity, or it receives goods in exchange for cash by incurring liabilities that are based on the price of the entity's share. So this includes both equity share-based, equity settled, and cash settled. And that's share-based payment transactions. That's share-based payment transactions. So the answer is C. Number 6, an entity issued a share option to its employees. The entity's share price is 18 naira. The employee have the right to buy these shares at 12 naira when all the vesting conditions have been met. The price of the share option is 7 naira. What is the intrinsic value?
B.
6 naira. That's correct. Which is the share price minus how much the employee is required to pay. And that's 6 naira. That's correct. B. Number 7, an entity issued share options to its employees on 30th June 2023. The end of the year is 31st December 2023. The employee will be entitled to shares on 30th September 2024. What is the grant date?
A.
That's correct. A. This is the grant date. I told you the grant date is the date where they enter into that agreement, that share-based payment agreement. And this grant date is very important. You'll see it very soon, how important it is. Okay, that's good. That means you guys were following. Okay, so let's go to how we account for share-based payment transactions generally. How do you account for it? So in accounting, when we say accounting for something or an item, we are talking about how we recognize it and how we measure it. That's what we are majorly talking about. So I will start with recognition. So how do we recognize share-based payment transactions? So you already know that there are 3 share-based payment transactions. The first one is equity settled share-based payment transaction. So how do we recognize that in the books? We recognize it by debiting expense or purchases or assets and by crediting equity reserves. Or if it is a cash settled share-based payment transaction, we recognize that by debiting expense or assets and by crediting liabilities. Because don't forget, for cash settled, we are paying cash. Just that we are not paying that cash immediately, we are paying it later. And that cash is based, the amount of cash we are paying is based on the share price of the company. It's based on the share price of the company. So we are debiting expense or assets and we are crediting liabilities. Okay. What about if we had a third one? The one I said, equity or cash settled share-based payments transactions, where either the entity or the counterparty has a choice of how the entity will settle those goods or services. How will it settle? Okay. That's equity or cash settled. In that case, we will simply debit purchases or we debit expense or assets. Just call it or assets. Then we credit either equity or liabilities. I would teach you this equity or cash settled also. With this equity or cash settled, where there is a choice of settlement, where either of them can decide. But now, the thing is that when they consummate the transaction, they will not be sure how the entity will settle. The entity is not sure how it will settle. So he doesn't know whether it's going to settle in shares or whether it's going to settle in cash. He doesn't know. So he will need to recognize elements of the two. So with this one, I'm going to introduce you to something like a compound financial instrument. That's a compound financial instrument, which I will also still teach you in IFRS 9. Okay, so those are the three share-based payment arrangements, and that's how we recognize it. Okay, you see, these share-based payment transactions, if this transaction were consummated with a supplier, for example, at what point do you think we can recognize the transaction in our books that we can go ahead and debit expense, credit, equity reserve? When can we recognize it in our books? If the transaction is consummated with a supplier, you can guess that it will be when the supplier has delivered the goods or when we have received the goods from the supplier. That's when we'll be required to recognize it. However, if the transaction was with an employee, if the counterparty here is an employee, at what point can we go ahead and debit expense and credit equity? Is as soon as the employee starts working for us, as soon as they start working, that we start enjoying the benefits. Because for employee, the condition will have been that they will work for many years. So for him, we cannot wait until those periods before we recognize it in our books. So as soon as you start working, we'll be recognizing it gradually in our books. Okay, that's how this recognition works. Okay, so that's recognition. That's recognition. Now, of course, okay, let's look at some questions just to be sure that I was actually speaking. So, number one, it says an entity purchased a motor vehicle under an equity settled share-based payment transaction. How will this transaction be recognized? I think I will need everybody to participate here. I just mentioned this recognition very slightly, but if you don't know this one, there's no point of going ahead with this class because that's everything we want to learn in this class.
Sir, I'm just confused because when you said credit equity reserve, crediting equity reserve, is that not decreasing equity reserve, not increasing?
And it's increasing it. Equity is a credit item. So
Okay.
when you credit it, it's increasing it.
Okay.
So what's your answer? So I have had several answers. I've had A, and D, D. So D is the
D.
correct, yeah. Recognize assets and a corresponding increase in equity. Okay, because what we purchased is an asset, a motor vehicle. And that's why A is not the answer. So those of you that chose A, you're very close, but in this case, we actually purchased an asset. Number two, an entity received a legal service in exchange for its shares. How will this transaction be recognized? You received a legal service in exchange for its shares.
A.
Okay. Yeah, that's correct. The answer is A, legal service. Yeah, everybody got this one, right? So number three, an entity purchased goods under a cash settled transaction. How will this transaction be recognized? The answer is C. A purchased good. So I'll just take that as we are debiting purchases, which is an expense. And since it's a cash settled, which means we are going to pay cash, but later, and the amount of cash is based on the value of our shares. So that's why we are crediting liability. So the answer is C. Okay, good. That means you are following, at least for most of you. So you know how to recognize share-based payment, both equity settled, where you debit expense or assets, and you credit equity reserve. If it is cash settled, you know that you debit expense or asset and you credit liabilities. So let's go to measurements. Measurements. So, I mean, you already know how we recognize it. So you see, when we say measurement, we are talking about, okay, how much, the amount at which we are going to recognize these items. So the issue here is this. The issue here is this. This is where the problem started from. Let me start with, I'm starting this measurement with equity settled. So later, after equity settled, I will go to cash settled. Then I will go to equity or cash settled. So I'm starting with equity settled. So the issue here is this. If you look at, we are debiting expense or assets with the goods or services received, Abi. We are crediting equity reserve with the shares or share option. The issue is that both of these items, they are, I can say, both of them are boss. They are oga of their own. In the sense that each of them have their own value. Because this expense or assets we are debiting, the supplier will have given you an invoice. So there's a value attached to it already. And you, that you decide that you want to pay with shares or share option, or you are surrounding your payment around your shares. Your shares also have its own share price. It has its own share price. So each of these guys have their own separate value. That's the challenge with this transaction. It's unlike every normal transaction that we are paying with cash. You bought an asset, you are paying with cash or you pay later. You bought printer, you borrowed money. Those ones are straightforward because you just deal with one value. But this one, what we bought has a value. The shares we are giving has a value. And you'll find out that ordinarily it should not be an issue if their value are the same, but they will never be the same. There will be different values. There will be different values. So which of them should we use? Which of them should we use? Now, IFRS 2 IFRS 2. Listen, listen. IFRS 2 says that we should measure the goods or services. We should measure this transaction based on the fair value of the goods or services that we received. Okay? We should measure this transaction based on the fair value of the goods or services received. So that means we are going to rely on the invoice that the supplier gave to us. And whatever amount is on that, that's the amount at which we are going to debit expense or assets. And with that amount also, we're going to credit equity reserve. Okay, so we are measuring it based on the value of the goods or services. That's the basis of measurement. That's the requirement in IFRS 2. It did not stop there. He now said that if the fair value of the goods or services, if it cannot be measured reliably, if we cannot get the value of the goods or services reliably, then we are going to measure it by reference to the fair value of the shares or share option. So if you cannot get this one, the price of the goods, if you cannot measure it reliably, then we use the price of the shares. Okay? But primarily, you should use the price of the goods to measure this transaction. But if you cannot get the price of the goods, you use the price of the shares. But the question is that in what situation are we not going to know the price of the goods? And that situation is simple. It is where this transaction is with an employee. If you had consummated this transaction with an employee, you cannot measure the fair value of the services you receive from the employee. And that's because in most instances, when we enter into this transaction with employees, it's always just part of their compensation. It's part of their remuneration. So meaning in addition to the normal salary they collect, we are saying, okay, we are promising that we'll give you some shares. So if the employee is now working, how can we then measure that, okay, this is the value of the service that we have gotten from this employee that relates to these shares we promised to give? So it cannot be measured reliably. So when is a transaction with an employee, we will usually use the fair value of those shares or share option where the transaction is consummated with an employee. And in the exam, in most cases, the question they will give you will be where the transaction is with an employee. So you find out that we are going to mostly use the fair value of the shares or share option in most of our questions, because in most questions we are going to be solving are questions that relate to an employee. Questions that relate to an employee. Okay. So I hope that is clear. Now, let's look at this scenario. It says, a company issued share options on 1st of June 2006 to pay for the purchase of inventory. The inventory is eventually sold on 31st December 2008. The value of the inventory on 1st June 2006 was 6 million. And this value was unchanged up to the date of sale. The sales proceeds were 8 million. The share issued have a market value of 6.3 million. How would this transaction be dealt with in the financial statement? Okay, so this one, the company issued shares, share options in exchange for inventory. Okay. So the value of the inventory is 6 million on the date they bought it. They sold the inventory for 8 million. The share price, the market value, or the shares they issue has a market value of 6.3 million. So how will this transaction be dealt with? Okay, so since this is a transaction with a supplier where they purchase inventory, and so the value at which we are going to use to measure this transaction will be the 6 million, which is the historical cost of the inventory, because we can measure the fair value of the inventory reliably. So we use 6 million. So we're going to debit purchases with 6 million, and we're going to credit our equity with 6 million. That's that. Okay. Now, one more thing. So from now going forward, the focus is going to be where this transaction is consummated with an employee, where the transaction is between an employer and an employee. That will be the focus going forward, because that's majorly what they will ask you in the exam. That's where the transaction is with a supplier is mostly straightforward, because all you need to do is, as soon as the supplier delivers the goods, you debit whatever it is they have supplied, whether purchases or assets, and you credit equity. And don't forget, you measure it at the fair value of the goods that is received. And that is all. But where the transaction is with an employee, it's not that straightforward, because companies or entities will give share options to the employee, which requires the employee to meet certain conditions. And those conditions will take many years. It will take many years. There are conditions that the employee would have to meet over time. So in that situation, how do we recognize such a transaction? Are we going to recognize that transaction when the employee has met the condition, or as the employee is meeting the condition? Of course, based on accrual basis of accounting, we are going to recognize the transaction over time as the employee is meeting the condition. Because as the employee is working with for us, transaction is already occurring. And accrual basis is that you recognize a transaction when they occur. And that is what I want to teach you going forward. That how much are we going to be recognizing, or how do we measure how much we are recognizing, what we are recognizing every year in respect of this type of transaction? And that's what we want to look at. Okay. So the standard says that when you consummate this transaction with an employee, and it takes many years, of course, it usually takes many years for the employee to meet that condition. How much are you recognizing each year? This standard says that each year you should recognize an estimate, or a best estimate of the number of employees that will vest. He said in each year, you should recognize an estimate of number of employees that will vest. What does that mean? It means that if you have, or if you give 1,000 options, share options to 20 employees, and the fair value of those options and the fair value of the option is, let's say, 3 naira. And we say that the employees must work for 3 years. And it says that the employee must work for 3 years. So how do we recognize this? What I've explained to you is this, that what is the standard says that you should recognize this transaction over the 3 years. Even though we know that before the employee can get this option, they must have worked for 3 years. They must have worked for 3 years before they can get it. But you will not wait until they have met the condition. You will start recognizing it as they are meeting the condition. I mean, that's the principle of accrual. That is how we recognize transactions in reporting generally. So the question then becomes, how much are we recognizing in year one? How much? Because we are saying that we are giving 1,000 options. 1,000 options to 20 employees. And each option costs 3 naira. If I multiply this, then I'll be looking at 60,000. Can we recognize this 60,000 in year one alone? That's not possible. The rational thing to do is to prorate it in such a way that we're going to have 20,000, which means that I can conclude that in year one, we'll recognize 20,000. In year two, we'll recognize another 20,000. And in year three, we'll recognize another 20,000. It's that simple. So all we just need to do is just to spread the value over the 3 years. But it won't be that easy in the exam. It won't be that easy in the exam. In fact, what the examiner will tell you, the examiner can tell you that in year one, they can tell you that in year one, 5 employees left. In year one, 5 employees left. So let me throw the question back to you. What would change in this calculation in year one? Knowing fully well that 5 employees left. Can anybody try? What would change in this calculation?
Numbers of employees.
What is it? Say it again.
I said numbers of employees.
That's
The
correct.
number
Thank you
of the
very much.
employees who.
That's absolutely correct. Thank you very much. That's absolutely correct. Number of employees. So instead of 20, this will become 15. Then our workings become 45. Divided by 3, then this becomes 15 in year one. So if they now say that in year two, let's say they said additional 3 employees left. What would our calculation look like? You can guess that it will then be 1,000 options times How many now? 12. Abi? Multiply by what? Multiply
2
by
over
3.
3.
Abi? Which will be how much? 36,000. Which we are still going to divide it by 3 to know how much we are going to recognize in year 2. So the key thing here is to know how many employees will vest. That is the idea. How many employees will vest? Because that is the whole idea that in each year, we are going to be making an estimate of the number of employees that we think will vest, that we think will remain for the remaining period or over the 3 years. Because those are the people that will get this option. Those are the people that will meet the condition. And that is the one we can prorate over the period. And that is what is happening here. And that is what we are doing. And that is everything we want to learn. So let's see if you were following me. Look at this. It says, when a service is satisfied over time, in the first year, the equity instrument is granted. In the first year, the equity instrument granted and the goods or services received will be measured at the fair value of the goods, fair value of the equity, best estimate of equity instrument expected to vest based on the first year estimate. So the answer to this one is the best estimate of equity instruments that we're expecting to vest. So the way we measure it each year, we're going to estimate how many employees will actually meet this condition. How many employees will actually meet this condition? Of course, at the vesting date. Okay, let's look at a more robust question together. Please pay attention to this. You get this, that means you get what we are talking about. So they say that on 4 January 2001, an entity grants 100 share options to each of its 400 employees. And each grant is conditional upon the employee working for the entity until 31st December 2003. The fair value of each share option is 20 naira. Okay, that's the first paragraph. In 2001, we gave 100 share options to 400 employees on the conditions that the employee will work till 31st December 2003. That means the vesting period is 3 years. And they told us that the fair value of each share option is 20 naira. Okay. So in this case now, what is the grant date? Which date is the grant date here?
1st January.
1st January.
1st of January. Okay.
No.
So one thing I did not remember to tell you is this, and this question is making me remember, is that when it's a transaction with an employee, we will measure those share options based on the fair value of those share options at the grant date. At the grant date. Though this question is straightforward, in some other question, they will give you fair value of those shares at each year end. Don't use those ones. The standard says that we should measure this share option using the fair value of the share option at the grant date. So, and they have given it to us as 20 naira here. Okay. Now, they told us that during 2001, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. Okay, let me stop there. So, based on my explanation, so how many employees are we going to use for our valuation? How many employees will vest? How many employees will remain till the end of the 3 years? Based on the information we have as of 2001. Remember that it is estimates we can only make based on the information we have, because there's no way we can know how many employees will leave for the 3 years. We can only know people that have left in year 1. But what we need is the number of employees that will vest, that will remain at the end of the 3rd year, based on the information we have in the 1st year. And it is those employees we are going to work with. So now, when they told us in 2001, 20 employees leave, and on the basis of that information, the entity estimates that 20% of the employee will leave during the 3-year period. So, how many employees will vest?
3 or 4.
I didn't hear you.
3 or 4 employees, 304.
How did you get that?
20 minus 400, then what is left? You estimate it with 20%. Like that.
Why are you doing that?
Okay, is the 20% on the 400 employees?
So what would that give you? Okay, somebody said 380. How did you get your 380? I guess 400 minus 20. People said 340. She has changed to 320. Why 320?
20% of 400, or 80% of the 400 will remain. That's what
Thank you very much. That's correct. So look at it again. It said during 2001, 20 employees leave. Okay. And the entity estimates that 20% of the employees will leave during the 3-year period. Right? So again, in year 1, what we need is an estimate of the employees that will vest. Okay. Yes, we can know the employees that will leave in year 1, because this is year 1. We know the people that will leave. But we can't know the people that will live in year 2 and year 3. We can only estimate. And that's why this guy, based on the 20 people that left in year 1, he now estimated, which is the requirement of the standard, an estimate of the number of employees that will vest. So he now estimated that 20% of the employees will leave over the 3 years. So that means 80% will remain. And Ibukun was perfectly correct, which is 80% times 400 is 320. Okay, let's try another year. It says during 2002, a further 25 employees leave. And the entity now estimates that 25% of its employees will leave during the 3-year period. Okay, so based on the information we have in year 2, so how many employees will vest? How many employees are we working with?
Tell them 25% of the employees will leave. There's only 75% that would be left to enjoy the vesting. So that's 75% of 400 employees.
Okay. Ibukun, you said 240. So please, I hear you. 75% of 400. Ibukun, you said 240. How did you get your 240?
Since we have 320 in the first year, so we are sure of that, right? So the second year,
I'm not sure of that. Is an estimate.
mm, is it not after the first year has completed, we'll do the second year? Are we?
The second year too, we are going to make a new estimate.
Oh, okay.
Is because we are still not sure how many people will live in year 3. It's an estimate. And the question is very clear that, okay, in year 2, a further 25%, 25 employees leave. So with that information, the entity it's very clear. It's a new estimate that 25% of his employee will leave during the 3-year period. So she's right. So Praise was right. So 25% of his employee will leave during the 3-year period. That means it's only 75% that will remain at the end of the 3rd year. It's an estimate. We are not sure. And the question has already told you the estimate. So 75% of 400, that gives 300. That's correct. They said during 2003, a further 10 employees leave. So how many employees will vest now? How many employees will vest now?
390.
345.
Okay. I can hear 390. I can hear 345. So Chris said 345. Husseini said 390. Apparently, you are doing 400 minus 10. That means you don't really understand this thing yet. If you are saying 390. So Chris, how did you get your 345?
In the third year, that's 2003. That's the last year where the share options can be converted to shares. So it will be based on the actual. 400 employees in 2001, 20 employees actually left. In 2002, 25 employees actually left. Then in 2003, 10 employees actually left. So 400 minus 20 minus 25 minus 10.
Okay, that's absolutely correct. So in year 3, which is the vesting date, we would now know the total number of employees that has actually left. There's no need for estimate anymore. There's no need for estimate anymore because now we know that in year 1, 20 left. In year 2, 25 left. In year 3, 10 left. So a total of 55 has left. So only 345 employees will vest. Okay, so that is the whole idea here. You will see the way we have gone about it, that before the vesting dates, in each year, we were making an estimate of the number of employees that will vest. And the question is not even going to wait for you to make the estimates. The question will give you the estimate. It's just for you to know what the principle says, which is for you to use in each year. In each year, you have to estimate because we are looking at the number of employees that will vest at the vesting dates. that will vest at the vesting date. So in year one now, they told us 20 left. So on that basis, they now estimated that, okay, 20% will live over the 3 years. 20% will live over the 3 years. So that means that based on the estimate given in year one, only 80% will vest. So we say 80% of 400 employees. That's 320. In year two, we'll make another estimate because we don't know. Now we are in year two. The estimate in year one was based on the information we had in year one. So we cannot rely on that estimate for year two. So in year two now, a further employees now leave. So we cannot, so estimate will change. So they now gave us that now, we now estimate that 25% of his employee will leave during the 3-year period. Okay, during the 3-year period. So in year two now, that means based on the estimate we are making in year two, we are saying that only 75% will vest. If we are saying 25% will live over the 3 years, that means at the end of the 3rd year, only 75% will remain. So we are going to work with 75% of 400 in year two. Now, in year three, this one is the easiest one. Because in year three, which is the vesting date, we now know the total number of employees that have actually left. There is no need for estimates anymore. There is no need for estimates anymore. So because in year one, 20 left, in year two, 25 left, in year three, 10 left. So a total of 55 has left. 345 are the ones that will enjoy the option. And that's the principle. In each year before the vesting date, we are estimating. Okay? Okay, that's that. But for those of you that are not participating, I don't know why. Maybe you are sleeping right now. I don't know, but only praise and very few of you. Like Christiana was participating, maybe she has slept. Chidima, she is not participating again. Ibukun, yes. Husseini, you are participating. So I will need you guys to participate now. Every one of you, because you are not plenty in this class. And I need all of you to pass this exam. So let me give you another dynamics of this. Let's say the question told us that 20 employees leave. Let me write it here. Permit me to. Let's say the question says that 20 in year one, in 2001, the question says 20 employees leave. And estimates that 10% will leave in year two and three. What if the question is, no, let me do 20%. Okay, let's say they told us that in 2001, 20 employees leave, and the entity estimates that additional 20% of employees will leave in year two and year three. So what do we work with in this instance? I need a response from everybody.
I don't understand the question.
20 employees leave in year one, and the entity estimates that additional 20% of employees will leave in year two and year three. This is year one. We know that 20 employees have left. So we're not estimating that additional 20% will leave in year two and year three. The question is very,
No estimate for the year one.
What is it?
No estimates for the year one.
It's no estimate for the year one. Okay. You that you say you don't understand the question. Tintin. What's your name exactly? I'm sure it's not Tintin. So what's your name exactly?
No.
And no, okay.
Yes,
So
sir.
what is the answer? I want you to tell me how many employees will vest?
Okay, at the end of year 3.
Yes.
Okay.
Based on the estimate we are having in year one now.
Okay, sir.
Okay, assessment. I don't know if first year is 20 employee, that's to say 380 will remain, and also this 20% respectively. That is to say 60 in all. Maybe we'll have 340.
Okay, I mean, you have tried. So you are saying that 340 will remain. Messi, I don't know if you wish to talk. How did you get your 304? Either you or Christina. You
Um,
have 304. How did you get that?
Good evening, everyone. So I what I did was I took out the 20 employees from the 400, then did 80% of the balance. That's 80% of 380.
80% of 380. Okay. Yeah, that's logical, which is what Christina also did. Any other conflicting answer? Ibukun, you're not saying anything. Chris, I've not heard you. You have one that's been active here. Those that said 304, that's not the answer. Christiana Messi, 204 is not the answer. Hussein, 340 is definitely not the answer.
Mm,
Abidemi, 380 is definitely far from the answer. Okay, let me tell you the answer.
60?
No. So Christiana and Messi were very close. Very close. In fact, they should have been correct. It's just a calculation. It's just the way, maybe the way it was expressed. So the first thing is this. 20 actually left. We now estimated that additional 20% of employees will leave. So what they now did was 20% of 380. Okay. But what the examiner will have want you to do is 20% of the total number of employees, which is 20% of 400. So 20 people left in year one. We now estimated that additional 20%. So 20% of 400 is 80. So additional 80 will leave in year 2 and year 3. So that means the estimate of total departure is 100. Right? So that means the number of employees that will vest is 300. Okay? So Messi and Cristiano, you guys definitely understand what we are talking about. So it's just an issue of miscalculation. So let me do
Please
it like,
repeat yourself again.
I should repeat myself.
Yes.
Okay. So they said 20 employees leave in year one
Mm-hmm.
and estimates that additional 20% of employee will leave in year 2 and year 3. All you just need to do is, okay, what's the estimate of total departure? How many people are leaving over the 3 years? So 20 is leaving in year one. Additional 20% of our employees, so 20% of 400 will leave in year 2 and year 3, which is 80. So 80 that we estimate to leave in year 2 and year 3, plus 20 that have left in year 1. So the estimate of total departure is 100.
Okay, clear. Thank you.
Right. Okay. For me to know that it's clear, Isan, what if they told us that what if this is how it is structured? That 20 employees leave in year 1 and estimate that additional 30 of employees will leave in year 2 and 45 employees will leave in year 3. So how many employees will remain at the end of year 3? Esan,
305.
okay, that's correct. Is that Esan or was you saying it?
Yes, sir. Sorry, sir.
You saying it? I said Esan.
So
He has decided not to talk. Don't talk. Oh. Okay. So I want to believe you understand it now. So what if they now said that in 2002, following from this one, they said in 2002, the entity estimates that additional 50 will leave in year 3. Okay. What if they actually told us that no employee left in year 2 and the entity estimates that additional 50 will leave in year 3? So based on this year 2 estimate now, how many employees will vest? What's the estimate of employee that will vest in year 3?
Sorry, Mr. Wasi, sorry to draw you back. I have some
Yes.
observation, please.
Okay,
Question.
please. All right.
For the estimate, do we consider the estimate after the last year of vesting? I think that's where I'm not getting it.
Okay. So
I thought, okay.
So how you will get it is this, in 2001, focus on 2001. What we need in 2001 is how many people we vest at the vesting dates. And we can only know what will happen in 2001. For 2002 and 3, as far as 2001 is concerned, we can only make an estimate. And the question will tell you all of that. So this scenario I gave you, they said 20 leave because we are sure we know this 2001. So 20 left in 2001. The question now told us that we estimate that additional 30 of employees will leave in year 2 and 45 will leave in year 3. So that means the estimate of total departure is now 20 that actually left plus 30 that we are estimating will leave in year 2 plus 45 that we are estimating will leave in year 3. So estimate of total departure is 95. So the number of employees we are going to work with in 2001 is 305. So out of these 400 employees, we are estimating that 95 will leave over the 3 years. That's the principle. That is the principle here. That in each year, before the vesting date, you have to estimate the number of employees that will vest. You need to remember that. The number of employees that will vest. So the question will give you everything you need. It's just for you to know the principle that in each year, we want to know the number of employees that will vest. So in 2001, we can only know people that will leave in 2001. We cannot know people that will leave in 2002 and 2003 in 2001. It's not possible. So we can only estimate, and which is why the standard asks us to estimate. And the question will give you the estimate. So they gave us the estimate of those that will live in year 2 and those that will live in year 3. So the estimate of total departure is 95. So Abidemi, did I answer your question?
Yes, please. Thank you, sir.
Okay. Now don't behave like Isan that ask a question. And for us to be sure that, okay, he understands what we are talking about, we asked him a question. The man refused to talk again. So I'm going to ask you a question, and just for me to be sure that you understand what I'm talking about. So in 2002, they said no employees left in year 2. And the STT estimates that additional 50 will leave in year 3. So what's the estimate of total departure?
Okay, so for 2002, no staff left for 2002, but 50 staff left in year 3. So out of 400, 50 left. So that's 350.
So 350 is your answer?
More like it.
Okay. So you're saying that 350 are those that will remain at the end of year 3.
At the end of the vesting period.
At the end of the
Yes.
vesting. Okay. Thank you. At least you have tried, but you are wrong. Praise. I said praise. Yeah, praise. Also, you said 350. Christiana and Messi, both of you said 330. Okay. You're actually right. 330 is the answer. So how did you get your 330? Messi, Christiana.
So I deducted the 50 and the 20 employees from 2001
Thank
from
you
the
very
total value.
Thank you very much. Thank you. So you cannot, in 2002 now, they said, okay, nobody left in 2002, but we are estimating, because we cannot know people that will live in year 3. We can only estimate that, okay, additional 50 will live in year 3. So in our head, don't forget that 20 already left in year 1. So the total departure is 70. 20 left in year 1, nobody left in year 2, but we have estimated that additional 50 will live in year 3. So total departure is 70. So the estimate of employee that will vest is 330. It's 330. So let's say in 2003, they said that no employees left. So Praise, what's the answer to this one? In 2003 now, how many employees will actually vest? How many employees will actually vest? Okay.
So I'm still looking at it though. I think 380.
How did you get 380?
So in 2001, 20 employees leave, like actually. In 2002, no employees left, actually. In 2003, no employees left. So that's like 400 minus 20 minus 0 minus 0. So 380 are those that would
Okay, you
just
said
remain.
380. So Kelvin said 380, Christiana 380, Abide made 330. Abide, how did you get 330?
I've seen my error.
Yeah, good. So it's 380 that actually left. 380 actually left. Okay. Any question thus far?
So in
Oh,
2001, okay, and
okay.
2002, before the last year, I thought we just focus on the estimates alone.
Yes. We
So I was,
focus.
okay.
The idea is not to focus on the estimate alone. The idea is understanding that what we need is an estimate of total departure. What we need is an estimate of the number that will vest. So it depends on how they structure the question. It's not about saying, okay, so since in 2001, we know that people leave. And we know that we cannot know people that will live in the next years. We can only estimate. So when they give you that estimate, so you would add together actual and estimate for you to know the total departure. That is the idea. So don't say, okay, we focus on estimating. No, it's by the time you mix both actual and people that you estimate to live in the future years, then you get estimate of total departure. Then you can then know the number of employees that will vest at the vesting date.
Okay, so I can go to that other example that had percentage.
Okay, this one,
Is it?
Abi?
Okay,
Okay, we'll
yeah.
come back there, but I want to answer a question. Husseini said
And
that, what if some employees join? Okay, so those ones also will have, those ones, we are going to do it separately. We are not going to mix it with this one that is ongoing. Okay, if employees join, those ones too will have their own 3 years. So their calculation will be separate from this one. We will not mix it with existing share options. So it's category by category.
Okay, thank you, sir.
Yeah. Okay, so let's come back again to this question. So I'm taking my time on this one because as soon as you get it, that is it. It's over. What we are discussing right now, that is all IFRS 2 is all about. The only difference is when I'm teaching you deferred tax implication of all of this. That's the only difference. But you understand this, that's IFRS 2. It's over for IFRS 2. So that's why I'm taking my time giving you all sorts of dynamics just for you all to understand. So if you are not participating, you are not getting it, you are not participating, you are not asking questions, or you are sleeping on your own, before you understand it, it will take hours. You have to go and listen to videos again and again, when you can easily ask me questions now. Okay, back to this one. During 2001, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. So this one is, let me say, straightforward. So, of course, this is year one, we know the people that will leave. But for the remaining period, we don't know. But this question decided to estimate for the entire period. I mean, that is how this question is. This one is structured. So unlike the hypothetical one I gave you, where they estimate for the remaining periods, this one decided to estimate for all the years. They can structure the question that way too. So this one has considered this 20 in his estimates. So, which is more straightforward. So that means the estimate of total departure is 20% of 400, which is 80. So that means 320 are those that will vest at the vesting date, based on 2001 estimate. Based on 2001 estimate. Okay? Or we can simply put that Since 20% will leave over the 3 years, that means only 80% will remain over the 3 years. So based on 2001 estimates, 80% of 400 employees will vest at the vesting date. In 2002, they said a further 25 employees leave. And the entity now estimates that 25% of its employees will leave during the 3-year period. Again, based on the information we have in 2002, we are now doing another estimate that 25 now. We say that it's like saying, okay, 20% will not work again. Since we have a new information that 25 people have left again. So we're now estimating that, okay, 25% will leave over the 3 years. Again, this question is giving us estimate of departure over the 3 years. Okay, so that means only 75% will vest over the 3 years. As far as 2002 information is concerned, 75% are those that will vest, which is 300. And at the vesting date itself, a further 10 employees leave. And at the vesting date, we can know the people that actually leave. We can know the people that actually what? Leave. The others left over the 3 years. Because 20 in year 1, a further 25 in year 2, a further 10 in year 3. So a total of 55, making 345 will vest at the end of year 3. Any questions? Any questions? Any questions? Okay. If there are no questions, I would stop here tonight intentionally. Go and take your time to look at all these principles, the foundation that we have built on this topic. Go and read it. Next week, we're going to round it up. All we'll just be doing next week, I won't take so much of my time to explain again like this, because I've actually explained everything here. Everything. So next week is just for us to solve questions. We'll just be solving all, and I'll bring in some new things, not so new, but it's just to solve questions, solve questions, solve questions. And there are many questions here to solve. So, do you have any question?